November 10, 2025. The man who made $100 million betting against the entire financial system just did something he's only done once before in his career. And the last time he did it, the global economy collapsed 6 months later. Michael Burry has shut down his hedge fund. But before you think this is just another wealthy investor retiring, let me show you the 3 things he did right before closing shop that should absolutely terrify you. Because what he's betting against right now isn't mortgages or banks. It's sitting in your retirement account. And if he's right again, you have less than 18 months before it all comes crashing down. I'm going to walk you through exactly what Burry knows that Wall Street doesn't want you to see. But first you need to understand why this man's track record makes him impossible to ignore. In 2005, while every bank, every government official, and every financial expert was celebrating the housing boom, Burry was reading mortgage documents, not summaries, not analyst reports, the actual loan files. 500 pages of legal jargon that nobody else bothered to read, and buried in those documents he found something that made his blood run cold. People with no income, no job, and no assets were getting $500,000 loans. Not occasionally, systematically, across millions of mortgages. Everyone told him he was insane. His own investors tried to sue him to stop the bet. Banks laughed at him. CNBC called him a lunatic. But Burry had done something nobody else had. He'd actually looked at the evidence. And when the math doesn't work, the math doesn't work. No amount of wishful thinking changes that. In 2007, his fund returned 489% in a single year while the entire global financial system was imploding. He personally walked away with over $100 million. Then he closed his fund, converted to a family office, and disappeared. Sound familiar? Because he's doing it again, right now. October 27, 2025, Burry sends a letter to his investors. And I want you to pay very close attention to the exact wording he used. My estimation of value in securities is not now, and has not been for some time, in sync with the markets. Let me translate that for you. The man who correctly predicted the biggest financial crisis in modern history is telling you that prices have completely disconnected from reality. He's not saying stocks are a little overvalued. He's not saying there might be a correction coming. He's saying the entire market has entered la-la land and he can no longer operate rationally within it. But here's where it gets absolutely fascinating. Before shutting down, Burry filed one final position report with the SEC, his 13F filing from Q3 2025, and when you look at what he was holding, it reads like a declaration of war against Silicon Valley. $912 million input options against Palantir. $186 million in puts against Nvidia. These aren't short-term trades expiring in a few weeks. His positions extend all the way to 2026 and 2027. He's betting that the 2 darlings of the AI revolution are going to crash hard and stay down for years. Now pause for a second and think about the confidence that represents. You don't put nearly $1.1 billion into bearish bets extending 2 years into the future unless you're absolutely certain you've identified the next subprime mortgage crisis. And here's what should make your stomach drop. Burry has publicly accused these companies of accounting fraud, not in some vague interview. Explicitly, he's claiming that tech companies are manipulating depreciation schedules on their AI infrastructure to artificially inflate their earnings. Translation: the profits that justify these trillion-dollar valuations don't actually exist. Let me explain what that means in plain English. When a company buys $10 billion worth of AI servers and computers, they're supposed to depreciate that cost over the realistic lifespan of the equipment, maybe 3 to 5 years. But if they stretch that depreciation to 10 or 15 years, their quarterly earnings look much better because the costs are spread out over a longer period. It's not illegal if done properly, but if Burry's right that it's being systematically abused, we're looking at Enron-level accounting manipulation happening across the entire tech sector. And the market cap of these companies is in the trillions, not billions, trillions. Here's the number that should haunt you. Palantir is currently trading at over 300 times earnings. Let me put that in perspective. The historical average for the S&P 500 is 15 to 20 times earnings. Palantir is trading at 20 times higher than normal. That means investors are paying $300 for every $1 of annual profit. At that rate, it would take 3 centuries for your investment to pay for itself through actual earnings. That's not a growth stock. That's a Ponzi scheme with better marketing. But wait, it gets worse. Nvidia, the chip company powering the entire AI revolution, has a market cap of $3 trillion, larger than the entire stock market of the United Kingdom. One company making computer chips is supposedly worth more than every publicly traded company in Britain combined. Does that sound rational to you? Because Michael Burry is betting $186 million that it's not. Now here's where the pattern gets terrifying. This is only the second time in Burry's career that he's voluntarily closed his fund while markets were still rising. The first time was 2008, 6 months before everything collapsed. And he's not alone. Every single time in American financial history that legendary investors have walked away saying the math doesn't work anymore. A devastating crash has followed within 18 months. Not sometimes, every single time. Let me take you back to September 1929. Jesse Livermore was the greatest trader of the Roaring Twenties. In 1907, he'd made $3 million shorting a market panic. Back then, $3 million could buy you half of Manhattan. By September 1929, the Dow had tripled since 1924. Everyone was getting rich. Stock tips were passed around at dinner parties. Shoeshine boys were giving investment advice. Sound familiar? Livermore quietly closed all his long positions and started shorting the market. His associates thought he'd lost his mind. Why bet against the greatest bull market in history? But Livermore had seen something everyone else missed. Stock prices had completely divorced themselves from company earnings. The math didn't work. The numbers were fiction. October 24, 1929, the market crashed. By 1932, stocks had fallen 89%. Livermore made $100 million shorting the collapse. In today's money, that's about $1.5 billion. While millions of Americans lost everything, the man who recognized the pattern early walked away with generational wealth. Fast forward to March 2000. Julian Robertson ran Tiger Management, one of the most successful hedge funds in history. 31% annual returns for 20 years. Institutional investors fought for allocation spots. His fund managed $6 billion. And in March 2000, he shocked Wall Street by shutting it down entirely. His letter to investors was brutal. The current technology, internet, and telecom craze bears no resemblance to rational investing. He said he couldn't compete with mania because he refused to abandon fundamental analysis for speculation. The financial media destroyed him. CNBC called him a dinosaur. Tech executives mocked his old-fashioned thinking. Investors yanked billions from value funds to chase internet stocks with no revenue, let alone profits. Pets.com was spending millions on Super Bowl commercials while losing money on every transaction. But the stock kept going up because the internet changes everything. Robertson looked like a fool. For exactly 1 month, the Nasdaq peaked at 5,048 in March 2000. By October 2002, it had crashed 78% to 1,114. $5 trillion in market value evaporated. Pets.com went bankrupt. The new economy that was supposed to change everything proved to be built on nothing but marketing and hope. Do you see the pattern emerging? Legendary investor recognizes unsustainable conditions, walks away saying the math doesn't work, gets mocked by the establishment and the media, then gets proven catastrophically right when reality finally reasserts itself. Livermore in 1929, Robertson in 2000, Burry in 2008, and now Burry again in 2025. Here's what makes this moment even more dangerous than 2008. Back then, the bubble was concentrated in housing and related financial products. If you didn't own real estate or bank stocks, you had some insulation. But this AI bubble has infected everything. Your 401k, loaded with tech stocks, your pension fund, overweight Nvidia and Microsoft, your index funds, dominated by the Magnificent Seven tech companies that now represent $15 trillion in market cap. 7 companies, $15 trillion. That's larger than the entire economy of China, larger than the European Union. 7 companies are supposedly worth more than the combined economic output of billions of people. Pop quiz, does that sound sustainable? Because Michael Burry is betting $1.1 billion that it's not. And here's the mechanism that makes this so dangerous. When bubbles burst, they don't deflate gradually, they implode. Because modern markets aren't driven by fundamental investors anymore. They're driven by algorithms, momentum traders, and passive index funds that automatically buy whatever's going up. When the reversal comes, all those automatic buy orders turn into automatic sell orders. The crash doesn't happen in slow motion. It happens in days, sometimes hours. In 1929, the initial crash took 1 week. In 2000, the Nasdaq lost half its value in 6 months. In 2008, Lehman Brothers went from being a 150-year-old institution to bankrupt in 3 days. The velocity of modern crashes has accelerated because leverage and automation have amplified every move. When it turns fast. Now, here's what should terrify you most. Burry is converting to a family office structure, which means no more public reporting requirements. After November 2025, we won't see his positions anymore. He's going dark right when markets are hitting all-time highs. His last tweet before going silent. On too much better things. November 25th. That's not the language of someone who thinks everything is fine. That's someone who's positioned for disaster and doesn't want anyone following his trades. Think about what that means. The man who correctly called 2008 is now making moves he doesn't want the public to see. He's spent months building massive bearish positions against AI stocks. He's accused these companies of accounting fraud. He's closed his fund using identical language to 2008, and now he's disappearing from public view. If that doesn't make your stomach drop, you haven't been paying attention. Here's the brutal truth about financial crashes. The insiders always know first. Company executives exercise stock options and sell at the peak while telling the public everything is great. Venture capital firms cash out their positions while pension funds load up on growth opportunities. By the time ordinary Americans realize what's happening, the smart money is already in cash, gold, and treasury bonds. The winners in 2008 were the people who recognized the pattern early. Burry made $100 million. John Paulson made $15 billion. Kyle Bass made hundreds of millions. They didn't have inside information. They just did the math and had the courage to act on it when everyone else was calling them crazy. The losers were the people who trusted CNBC, believed real estate never goes down, and learned too late that when housing prices are built on fraud, the collapse is inevitable. This time, the losers will be anyone holding AI stocks at peak valuations. Convinced that artificial intelligence changes everything and justifies prices disconnected from reality. The winners will be the people who recognize that human psychology never changes. Greed, fear, and the belief that this time is different have driven every bubble in history, and they're driving this one too. Michael Burry is walking away from the poker table, not because he's losing, because he's realized the game is rigged, and when everyone else figures it out, the stampede for the exits will be catastrophic. In 1929, Jesse Livermore warned the market had become artificial. Most investors ignored him and lost everything. In 2000, Julian Robertson warned tech valuations bore no resemblance to rational investing. Most investors ignored him and lost everything. In 2008, Michael Burry warned housing finance had become fraudulent. Most investors ignored him and lost everything. In 2025, Michael Burry is closing his fund, going dark, and betting $1.1 billion that AI stocks are the next disaster. History doesn't repeat exactly, but it rhymes so loudly you'd have to be deaf not to hear it. The pattern is always the same. Brilliant investors recognize mathematical impossibilities, warn about unsustainable conditions, get mocked by the crowd, then get proven right when reality finally breaks through the delusion. The man who called 2008 is calling 2025. The only question that matters is this: will you listen this time? Or will you join the long list of investors who learn too late that when legends like Michael Burry walk away, they're not abandoning opportunity, they're avoiding disaster?